Hello, everyone, and welcome to this live session with Askpb, our newest series to decode all things about insurance. Now, Askpb एक ऐसा प्लेटफॉर्म है जहां पर आप इंश्योरेंस से रिलेटेड कोई भी सवाल पूछ सकते हैं एंड आवर डोमेन एक्सपर्ट विल आंसर योर क्वेरीज. तो अगर आपके कोई भी सवाल है तो प्लीज डू नॉट हेसिटेट. आप डिस्क्रिप्शन बॉक्स में जाइए, वहां अपने क्वेश्चन छोड़िए एंड वी विल श्योरली गेट बैक टू यू. Now, coming back to today's show, we have Sameep with us. Sameep is the business head of investment and savings at Policybazaar, and he will be solving all your queries about FDs, mutual funds, ULIPs, and SIPs. Welcome to the show, Sameep.
Thank you, Simran. Hi. Hi, everyone.
So, let's get started. My first question to you, Sameep, is that I think our viewers would like to understand what are the key differences between all four of these investment products.
See, the four investment products, if you would categorize them as, the first thing that comes to people's mind in the retail space would be fixed deposits.
Okay.
Now, fixed deposits, people who generally want fixed returns, guaranteed returns, and want liquidity as well because it's easy to withdraw if you need money. So a lot of people do that. Returns currently are on a upswing, and you are getting around 7-8% taxable, but they are on upswing currently. So that is one instrument that most people invest in. The others, where people looking for slightly higher returns, do SIPs SIPs are nothing. You can do SIPs, a systematic investment. Now it can be in a mutual fund or any other product for that matter, or a ULIP also for that matter. ULIPs are market linked insurance plans. So SIP is just a systematic monthly investment. Now on the mutual fund side or ULIPs, both have a if you invest in equity instruments, basically the underlying assets in both are the same. That these are stocks, and you have a variety of funds to choose from. So you can either do large caps, mid caps, small caps, whatever, and the underlying asset are stocks. You can also do debt funds where the underlying assets are AAA rated, corporate debt or government securities or state government securities for that matter. So the debt instruments are predominantly used for people looking for 8 to 9% kind of very, very, very stable returns. But they are taxable now. So now the need for them has kind of gone down. But these are the four category of investments that people can consider.
All right. Now, in terms of risk and return, Sameep, how do these four investment products compare with each other?
See, from a risk perspective, FDs are very secure, but FDs you should only do it in large banks like State Bank, HDFC, all those banks only. My suggestion would be to not go do FDs in smaller banks, even though they offer higher rates of interest. We have had instances of banks not being able to be able to pay the interest after a point of time. So my suggestion would be to only do it in bigger banks. Now, from a risk return perspective, see, any FD, the government guarantees up to 5 lakhs from Deposit Credit Guarantee Corporation. So if the bank goes bankrupt also for any reason, then still 5 lakhs, up to 5 lakhs is secure. But if you do it in a large private sector or public sector bank, it's majorly secure and you don't need to worry about anything. Apart from that, if you move to slightly equity related investments, then obviously these are not very secure. When I say not secure, because these are dependent on market fluctuations. If the markets go up, the returns would go up. If the markets go down, obviously the returns would go down. But here what I would say is that if you invest for the long term, see, over 10 years or 15 years, Indian equity markets have never given negative returns. So if your investment horizon is 15 years, you would never get a negative return for sure. Whatever you've invested, whatever principal you've invested, you will always get that back. Plus you would get more also. So, but the investment horizon needs to be slightly long term. Because what happens generally is in the short run, markets can be extremely volatile. In the last 1 year also, currently the markets are on an upswing, but markets were choppy. They used to go down and were trending around this 58 to 61,000 level, in the last 6 months to 1 year. So they can be extremely volatile at times in the short run. But in the long run, these things kind of smoothen out. And from a risk return perspective, over a 20-year period, I don't think you would you would see a scenario where you end up getting negative returns.
Correct. All right. So, Sameep, while choosing where to invest between these four products, what factors should one consider?
See, when choosing to invest in these products, the factors that one should, consider is that first thing that you need to, consider is that you should always have a slightly long term horizon. Now, in the short run, you will never be able to make, extraordinary gains, right? If you invest, maybe if you invest 10 lakhs at one go also, first of all, a lot of people will not have an ability to invest 10 lakhs at one go. But if you are able to also, in a 1-2 year period, you should, you will never be able to make that 10 lakhs will not become 20 lakhs in 2 years. So expecting those kind of returns will not get you those returns actually. So that is the first thing. You should have a long term horizon. Have a 20-year horizon. Invest 10,000 rupees a month over 20 years in an equity investment at a rate of 10 to 12%. You will end up around 1 CR. So see, that 10,000 rupees over 20 years will become 1 crore. So that is the beauty of power of compounding, right? And if you delay this investment and you do it only over 10 years, then you only end up getting 25-30 lakhs. So there, the gap between the returns is very high. So the biggest thing is start early and have a long term horizon. So that's the most important factor, I think. And the other factor is, see, everybody has their own risk appetite. Now, when I say you have your own risk appetite, what I intend to say is that, see, if you are extremely afraid of market fluctuations, then maybe you should do FDs, because you need some money liquid, right? And getting 6.5-7% also, or right now 8%. That's a good return to get, right? So you get that currently, but you should not only do that, because it is taxable, not very tax efficient. And you should do debt funds. Debt funds is also an option that you could consider if you're not very risk oriented. If you're risk averse, then debt funds make sense. You get 7 to 8% in a ULIP debt fund. We will cover that in the later part of the segment also, but are extremely tax efficient, because up to 2.5 lakhs of annual investment you get tax free returns. So debt mutual funds have become taxable. So I'm not really sure whether you should do those now or not. And debt mutual fund investments also post the budget changes after 31st March, where debt mutual funds became taxable. They'll be taxed as per your tax slab. Post that, debt mutual fund investments have also gone down. So if somebody is risk averse, FDs or debt ULIPs. And the third thing that comes to my mind is guaranteed return plans, where you get, there again less liquid, but a 7.5% tax-free return is something that you should consider. So the two important factors to consider is, how is your risk appetite and how long can you think of. My suggestion is you should have a long-term horizon when you're thinking of investments. That's about it.
Correct. Thank you for explaining that so beautifully, Sameep. Now, I know the power of compounding interest, you know it, but for our viewers who do not understand how compounding interest works, can you please explain, and can you please also explain how this concept applies to these investment products?
See, power of compounding is basically, see, the money keeps growing year on year. It earns interest, and it keeps earning interest year on year, right? So the thing is that, see, I will explain how. So I'll explain it with an example. So if I take a 10,000 rupee investment, okay, and I do it in a debt fund for that matter, okay, debt fund over at 8% rate of return at 10,000 rupees would give you around 55 lakh rupees over 20 years, right? And if you do the same investment at 12% rate of return in an equity mutual fund or equity ULIP, that will give you around 12-13% rate of return, and over 20 years again, and that will give you close to 1 CR. So you see, the beauty of power of compounding is, if you get a higher rate of return, around 12-13%, at 10,000 rupees a month for 20 years, you can make 1 crore of corpus at just by investing 10,000 rupees a month. And if you get a lower rate of return, around 8%, the value drops to as low by around 40 to 50 lakh rupees, right? So the thing is that you just need to stay invested in the right set of products. Obviously, you need to keep monitoring, how much returns I'm getting year on year. But if you do an equity investment over 20 years, you should get 10 to 12% very easily. It's not guaranteed, obviously it's market linked, but you should get that. And if you do an equity ULIP, obviously the returns up, if your annual investment is less than 2.5 lakhs, it will be tax free. So that's an arbitrage that you have against mutual funds, because mutual fund returns are taxable. So that's the predominant thing, that how money would grow if you just stay invested over 20 years is extremely important to build your corpus.
ऑल राइट, समीप आपने बात करी डेट फंड्स के बारे में, राइट?
Okay.
तो क्या आप एक्सप्लेन कर सकते हैं कि डेट म्यूचुअल फंड और डेट यूलिप में क्या की डिफरेंसेस होते हैं?
See, debt ULIPs versus debt mutual funds, again the underlying asset is the same, where the underlying asset here is corporate bonds or government debt, or state government debt. So, and these both instruments would give around 7 to 8% rate of return. So the rate of return would not be exceptionally different, right? 7-8% is what we should expect over a 10-year period. Now, the biggest difference arises here is that post 31st March 2023, debt mutual funds became taxable. Now, once they became taxable, whatever returns you get, so I take an example here. If you invest 20,000 rupees a month, okay, that is 2.4 lakh rupees a year for a 20-year period. Okay, so you end up investing around 48 lakh rupees. Now, this 48 lakh rupees at the end of 20 years would be 1 crore if you do a debt investment, and it gives you a return of 7 to 8%. Now, this debt investment in a mutual fund would be taxable as per your tax slab. Now, you have gained around 52 lakh rupees, right? This 53 lakh rupee gain will be taxed as per your tax slab, which will be around 31%. So, you end up paying 16-17 lakh rupees as taxes, which is a very high amount to pay as tax if you do a debt mutual fund investment. Had you done the same investment in a ULIP fund, the 1 crore would have been tax free, because your annual investment was less than 2.5 lakhs. Post 2.5, it is also taxable, but less than 2.5, it would have been tax free. So there's an immense tax arbitrage in the taxation of a debt ULIP and a debt mutual fund, whereas the returns are similar. See, the underlying asset remains the same, so the returns would not vary too much.
All right. Now, Sameep, you mentioned tax implications associated with debt mutual funds and debt ULIPs. Can you elaborate on the tax implications associated with the other two investment products as well?
So see, FDs, the first instrument that we talked about, they are currently giving you 8%, right? And so if somebody does a 10-year FD, they get around 7.5-8%, which will be taxable in the end as per their tax slab. So if you fall in the 30% tax bracket, right, then the net return that you get is around 5.5%. So again, you only end up getting 5.5% in an FD. Okay. If you do this similar investment, I'll do an FD versus a guaranteed return plan. That is an insurance plan which guarantees a return, which will give you a 7.5% tax-free return. So the return here would be tax-free if your annual investment is less than 5 lakhs. So here also a tax guideline changed on 31st March 2023, where annual investments of more than 5 lakhs in a guaranteed return insurance plan became taxable. So less than 5 lakhs is still tax-free. And if you get a 7.5% rate of return, tax-free, so 7.5 versus 5.5. So you get additional 2%, which makes a lot of sense to do, right? Make that investment choice. Now this is for FDs versus guaranteed return plans. Now I consider equity mutual funds. Okay. So in an equity mutual fund, I'll take the same example. If I had invested 10,000 rupees a month, so I do 1,20,000 a year. In 10 years, I do 12 lakhs, right? And over 20 years, that becomes 24 lakh rupees. Now, if this 24 lakh rupee investment over 20 years gives me a 1 crore return at the end of 20 years in an equity mutual fund, my net gain comes around 75-76 lakh rupees. That will be taxed at 10%. Long-term capital gains tax in mutual funds is at 10%. So you end up paying 7.6 lakh rupees as taxes, which is a substantial amount to pay as tax, right? And if your annual investment in ULIPs was less than 2.5, this 1 crore would have been tax-free. So in an equity ULIP, you don't pay 7.5 lakhs in taxes, and in an equity mutual fund, you end up paying 7.5 lakhs in taxes. plus the underlying investment in both the instruments is in stocks, right? So and you have a wide variety of stocks that you can choose, funds to choose from. So if you have a much larger risk appetite, you can invest in a small cap fund. Now ULIPs also have small cap funds. A Bajaj small cap fund got launched very recently, and which would give small cap funds give exceptionally high returns over long term, right? Or if you have slightly less risk appetite, slightly less, you want to take slightly less risk, you can choose a large cap fund. So the underlying instruments and choices are more or less same, but in one instrument you can get tax-free returns and save on 7.5, 8 lakh rupees of taxes. So which is a big arbitrage to utilize. Personally, if I have to make a choice, what I would definitely do is up to 7.5 lakhs in insurance products, 2.5 lakh rupees in ULIPs, and 5 lakhs in guaranteed return plans. So total 7.5 lakh rupees. If you invest annually, you can get tax-free returns on that. So I would definitely do that, and maximize my tax arbitrage and maximize my tax-free return.
Okay. Now, Sameep, I think when we talk about investment in general, liquidity is a very important aspect that we should touch upon. So when we look at these four products, how does liquidity vary between all four of them?
See, from a liquidity perspective, yes, insurance products are slightly inferior there. Yes, so FDs, obviously you pay a penalty of one odd percent, and you can withdraw them at any point of time. Mutual funds also have a 1% exit charge, and you can withdraw anytime. ULIPs, there you have to wait 5 years. See, but you should consider this, that why has IRDA, the government regulatory authority of insurance products, why has IRDA done that? Why does it have a 5-year lock-in in ULIPs? Is because sorry, is because it wants people to generate wealth. See, if you keep withdrawing from your corpus every 1 year or every 2 years, then you would never be able to generate sustainable wealth, right? The corpus will never grow. See, I'm always all the examples that I've taken where I end up making 1 CR are over a 15-20 year period, and I've invested not large amounts. I've invested 10,000 or 20,000 rupees, right? So unless and until you don't have a long-term horizon, and since IRDA wants you to do it for 10-15 years, they at least say that you should at least do it for 5 years. Because in 5 years, if you get a 12-15% rate of return annually, you can at least grow your corpus by 50 to 60%, right? If you keep touching it every 1 year and withdrawing from it, you would never be able to grow that amount substantially. So for that particular reason, they have put in a 5-year lock-in in ULIPs. So that being said, yes, mutual funds have no lock-in unless until you do a tax-saving ELSS mutual fund. FDs also have literally no lock-in. Just pay 1% penalty and you can withdraw the money. ULIPs there have a 5-year lock-in. But apart from that, there are other advantages that I've already mentioned. So people should make a wise choice, diversify. If you have short-term goals that you need to meet in 1 or 2 years, yes, please do a mutual fund. But apart from that, for your long-term goals, you should definitely consider ULIPs and guaranteed return plans also, for that matter, because they're extremely tax efficient and returns are at par with other instruments.
Perfect explanation, Sameep. Thank you so much. We have questions flowing in from our viewers, and we will be taking some of them up now. So Riddhi is asking, sir, I want to keep my money invested for a long period. Should I choose FD or should I go for ULIPs?
See, Riddhi, if you are less than, in the 25 to 45 age group, I would suggest that you should have a equity oriented investment portfolio. So because the younger you are, you should try getting higher and higher returns. And see, you have a 10, 15, 20-year horizon, definitely you should have equity related instruments in your portfolio. You should do equity ULIPs, diversify and do some equity mutual funds also. I'll not stop you from doing that, but returns on both would be at par. The end answer is, I would not suggest an FD unless until you need some short-term liquidity that you should have, maybe 3-4 months of salary for an emergency. That you should keep in an FD. Apart from that, I would not suggest doing much more than that.
Perfect. Riddhi, we hope your query was solved. Moving on, Dinesh is asking, I took a ULIP plan 3 years back for 10 years. It's giving good interest, but I want to know what's the maximum return I can get, and is SIP better than ULIP? So 2 questions.
See, the maximum return. See, returns are again market linked, and I've not mentioned which ULIP you have, taken. But see, there are funds in the market over which over a 10-year period have given as high as 20-21% returns also. That does not mean that you will get those 21%, but that is the kind of returns that have been offered by both mutual funds and ULIPs. So
Yeah,
see, that is the kind of historical return that has been given. Apart from that, see, you should keep switching your funds. See, so if you invest in a ULIP, there'll be 8 to 10 funds there, right? So you should constantly keep monitoring, every 6 months maybe, on what the returns these funds are giving. And if you feel that your fund is underperforming, you should switch to the other fund, and the switch is free of charge. So see, that is the beauty of investing in ULIPs. You can switch multiple times between funds, and the cost, there is no extra additional cost of switching the amount, right? So if you feel that your portfolio is dropping because markets have at times a COVID like scenario or some unforeseen circumstances happen because of which the markets drop, at that point you can switch to a debt fund also, where your returns would not be volatile. So you should keep doing switches. And again, market returns are market linked. They have given as high as 20-21% also in some funds. So you should just keep monitoring and switching basis performance. On the second question, is are SIPs better? See, as I mentioned earlier, SIPs are associated with mutual funds, but it's just basically a monthly investment that you do. If I, in a systematic planned manner, decide that on the second of every month or on the fifth of every month I will invest in a particular fund, that's an SIP.
correct.
Now this systematic planned investment can be done in a ULIP also, right? Where you say that on the second of every month there'll be a deduction from my bank account, and that money would get invested. Why should you do this? See, because it is extremely difficult to time the markets. Now, see, for a normal retail customer, you do not know when the markets are at the maximum and when they are going to fall, right? So the best strategy to adopt is that you keep investing monthly. How does it help you? So you invest on the highs and you invest on the lows as well. So you will never get the maximum return, but you will never also get the bottommost return also. Why? Because you're investing every month. If some month you've invested on a high, the other month you would invest on a low also. So what will happen is, over a 1 year or 2 year period, you will get average of the best possible outcome, right? So that is why SIPs are suggested to retail investors who do not have the time or the knowledge to time the markets. So they will give you an average return. That is why we suggest that over a 10-15 year period, 10 to 12% is what you should expect that you will get. I don't say you will make 20%, because I think if somebody who times the market correctly might make that 20%. But for a retail customer who does an SIP every month, 10 to 12% you will definitely make.
Correct. We have more questions coming in. Sanket is asking, Sir, there are new plans in the market like Smart FD. So, should I go ahead with that or should I go ahead with the traditional FD plans?
See, Smart FD is a very unique offering, launched, I think it got launched some 6 months back. So see, this plan offers a 7.5% rate of return, and so you do a 5 year investment. So for example, you do 40,000 rupees a month, okay? And you, at a 7.5% rate of return, you will make around 41 lakhs, 41.7 lakhs to be more or less precise. So this 41.7 lakhs will be tax free. And if you do not have any immediate liquidity requirements, right? If you have spare money and 40,000 rupees a month, see, if somebody does not have 40,000, he can do a slightly lower amount also. Returns would be still 7.5, but I'm talking about an amount which will give you a substantial amount of return also, right? So that is why I've taken an example of 40,000, and this is then less than 5 lakhs a year also. So your return would be tax free also. So if you do 40,000, you end up making 41.7 lakhs tax free. If you do the same amount in an FD, first of all, the problem would come is that you will not be allowed to do a 40,000 FD every month. So the return would keep changing. See, you do a 40,000 this month, but the next month, if you go and do an FD, the return might be different, right? You can't be assured that over a 5 year period, my FD return would not change, because in the last 10 years, FD returns have gone from 12% to 6%. Temporarily, they have again gone up to from 6 to 7, 8%. But again, they are supposed to go down once the repo rates again, the government starts revising the rates downward again. So The best answer here is that you should do a smart FD. 7.5 is a good rate of return to get. Uh, it is tax free. You will be able to generate a good corpus, and some amount you should keep in an FD, which as I always say, you need around 3 months of salary. That should be in an FD, so that any emergency requirement you can always reach out and get it.
Perfect. So Diksha is asking, I want to invest 5,000 rupees a month. What would be the best investment instrument for me?
See, Diksha, at 5,000 rupees a month, there are numerous products in the market that you can consider. There are 3-4 insurers that they have got excellent funds. There is Tata, there is HDFC, Birla, iPro for that matter. These companies all have got very good funds. You can do a ULIP investment. If you are slightly apprehensive of risk associated with equity, what you could consider is a capital guarantee product, where what happens, this is a very unique offering offered by Policybazaar, where a part of your money is invested in guaranteed return products, where the your principal is guaranteed. So if you invest 5,000 rupees a month for over 10 years, whatever money you invested, you will 100% always get that back. Plus, you get a market link upside. So some money is also invested in equity, which gives you a market upside. So these products, on an average will give you a slightly lower return than 100% equity investment. But for someone who is slightly less, wants a slightly less risky investment, our capital guarantee solution is also can also be considered. So these are the two solutions that I would offer.
Okay. So Raj is asking, what are the best investment options available for a senior citizen in India?
See, Raj, for senior citizens, so see, it depends again on what age group are you in currently. Now, if somebody is in the 45 to 50 and will become a senior citizen in the next 10 years, right? So that is one age group, right? Who will become a senior citizen, right? So for them, they can choose regular pay annuity products where see. So for senior citizens, there are two. They obviously need pension, right? So once you retire, you need income replacement. So if you are a 60-year-old, so I'll first explain the senior citizen part and then go to who will become senior citizens. So if you're a 60-year-old, obviously you've just retired, you would have got lump sum returns from your PPF, EPF, and you would also have saved for your retirement. So you would have, for example, have a 1 crore corpus. Everything included, you have saved 1 crore for your retirement. Now from that, my suggestion would be that 10-20 lakhs you should keep in an FD for any emergency. 40 to 50 lakhs, you should definitely buy an annuity product. An annuity product gives you a monthly income, right? This monthly income is guaranteed, does not change. You lock in the interest rate, okay? So if you do a 50 lakh investment, you get a 6.5-7% rate of return, which will never change for your entire life. So you see, and you can buy a joint life annuity product also, where you get income, then your wife also gets the same income after you pass away. So it and there is return of purchase price also. The 50 lakh rupees goes back to your nominee. So it's an excellent product. Your counter would be that I can just do an FD, get 7.5%. But if you do an FD, there's this term called reinvestment risk. What happens is that if I go slightly backwards, if somebody had retired 10 years back, okay, now he would have invested in an FD at 12%. But when he went to renew that FD today, he would only get 8%. That's the current interest rate, right? So your income would drop from 12% to 8%, right? So that's a 4% loss in earning. But had you bought an annuity 10 years back, annuity rates are almost at par with FD rates. You would have maybe not got 12% annuity rate, but you would have got 11%. But that 11% you will get for your entire life. You would still be getting that 11% when FD rate is 8%. So that's the arbitrage, and that's the benefit of buying an annuity. You lock in the rate for the next 20-30 years. See, because post-retirement also people live for another 20-25 years now. So that is a very long period of time. For that, you would want a fixed income that you will always get. So 50 lakhs in an annuity product, I said 20 lakhs keep in an FD for emergency. The remaining 30 lakhs, see, I always believe that some investment should always be there in equity, because you need to, have some investment that keeps growing at 10-12% rate of return, right? There is risk associated with it. but it should still keep growing at 10-12% because see, inflation in the economy is at 6%. Now, after 10 years, you will still feel again, if you get an 11% rate annuity also, that maybe this is also not enough because it's becoming more and more expensive to live in the country. So that extra 30 lakhs that you invested in an equity investment would also in 10 years become 50, 60 lakh rupees. So that would support your income after 10 years. So that is how I would have planned your retirement if you had 1 CR. Now, moving away from there, if somebody, and see, the same math applies to people who have a slightly lesser corpus also, right? The same split they can also do. Now, if somebody is 40 years, 45-year-old, and he wants to plan for his retirement, now here also they have deferred annuity products. Now, deferred annuity products are that you can lock in the interest rate that you will get at retirement today itself. See, so if you have a lump sum corpus, you can do a one-time investment. If you don't have a lump sum corpus, you can start investing monthly. You can start from as low as 10,000 rupees a month and get a monthly income once you retire at 60. And see, these also will give you a 6.5-7% rate of return. So see, because in 15 years, and why this is important is, see, in 15 years, India becomes a developed country, and you will not get a 7% fixed income rate after 15 years. You might just get 2 or 3%. So it is better if you are in the 45-50 age group to lock in that interest rate now for once you retire.
Wow, that was very insightful, Sameep. We have reached the end of today's session. So, thank you so much for joining. And thank you so much to everyone who tuned in and asked their questions and engaging with us. Thank you so much. If you have any further queries, please feel free to leave your questions at the link mentioned in the description box. We will be back again very soon with another informative session. Till then, stay safe.
Thanks, guys. Thanks, Simran. Bye.